Here we are again, now at derivatives. I know this topic causes some apprehension for students, so let's get through it. It is tested, it is needed, so we do need to get through it. There are basically four types of derivatives that we need to understand. Rights and warrants, which in the grand scheme are reasonably simple. We basically have one slide on each of them. There's a bunch of information, so it's a little more than simply the one slide could be thought of. But puts and calls, we do have a bunch of material to get through, and as you can tell by looking below, I do have a bunch of additional resources, pictures, and some animations to help you understand these better, because they are a tricky topic. Well, let's talk about rights. Well, before we talk about them, let's look at one. Here is a right, clearly a very, very official certificate here. It's got the official stamp and everything. Clearly an official company. We all have heard of the great generic company. But this is a company where right now the current market price is $100 per share. And if I own this right lets me buy it at $95 a share. I can buy 100 shares at $95 a piece. The problem, I only have 30 days in which I can do this. What a right is a short-term ability to buy the stock at a price below current market value. It is short term, 30 to 60, maximum of 60 days. The one I just showed you was 30. Many are 30, could be up to 60. It is issued with a purchase price that is below current market value. And it is used by pre-existing shareholders. If you remember when we talked about common stock, I mentioned about their preemptive rights, the right to maintain proportional ownership. I mentioned that there are 3 times that we talk about them. Once in common stock, once when we talk about underwriting, and once actually when we talk about the derivative called a right. These are given to pre-existing shareholders when a new issue is given, so that the pre-existing shareholders can maintain their proportional ownership. It is just given to pre-existing shareholders, but they can then sell it. It's basically the one I showed you is basically worth $5. If I can buy it 95 and it's worth 100, somebody out there is probably willing to give me $4.99 for it. I mean, if you want to get this stock, would you rather pay $100 or pay $99.99? That's giving me $4.99 and then paying $95 for the stock. So there's a total of $99.99. That's still cheaper than $100. So it's almost a $5 value in that right, and I have 30 days either to use it or sell it, or it's going to expire. And when things expire, we have to understand they go to zero. They don't go down in price like we normally think of with stocks. They go to zero. They become literally worthless. Warrants, on the other hand, well, let's look at one. Here's a warrant, again, from the very official company called Generic Company. This is going, again, before we get any further, the market price is still $100. And this great investment is going to let me buy it at $110. Wait a second. If the current market price is $100, why would I ever want to pay $110? I can go down the street to John's Discount Brokerage and I can get it for $100. That's what the current market price means. That's what it's worth. Why would I ever want this thing if it's making me pay more? Oh, I have 5 years to use this. Do I believe the generic company is going to be worth more than $110 within the next 5 years? Maybe. But that's the idea of a warrant. Warrants and rights are very, very similar. Warrants, though, are long-term, and they are issued with a price above the current market price, whereas rights are short-term and a price below the current market price. Let's look at some more details. It is long-term, 3 to 5 years. It could be perpetual. It could be perpetual warrants. That means forever. They don't actually expire. They are issued with a purchase price above the current market value. And they're used as a sweetener for bonds or preferred stock or some other security. They're not sold. Because if you could imagine that ability to buy at 110 really isn't going to be worth very much right now. Why would I really want to make that to sell it? It's not worth much. But what if I am trying to issue a bond? And I want to issue a 7% bond. I want to pay $70 a year on this bond. And you, an expert in bonds, are looking to make an investment, and you really like my company. You think my company is a good investment for the bonds, but with interest rates, with market conditions, you really want a little more than 7. You really think I should be giving 7.2 or 7.3%. Now, you might look at this now, sitting at the computer watching this, and go, well, of course, why wouldn't I give an extra $2 to get the money? You got to remember, this might be on $1 billion or more. If it's on $1 billion, that extra 0.2, 0.3% is $2 or $3 million a year in interest that I've got to pay. I don't want to pay $2 or $3 million a year. I really want a 7% bond, but I understand if I issue the 7% bond, it may not sell very well. You probably wouldn't buy it. You want a little more. But what if I sell the 7% bond and give you a warrant with it? An extra bonus, a sweetener. You want 7%. You want $70 a year per bond. Sorry, you want $73 a year. I want to give you $70. So how about we compromise? I give you $70 and this potential equity. You like my company. You said so. You want to invest. You just need a little bit more. But I don't want to give it to you each year in interest. I'll give it to you in potential equity. So I offer a warrant, and you might look at it and go, you know, I really do think that your company is going to do well in the next 5 to 10 years. I think it's certainly worth the $2 or $3 a year that I'm not going to be getting. I will buy your 7% bond and get the warrant. Warrants are a sweetener. Rights are given to current stockholders. Warrants are given to people who are buying current bonds or preferred stock or similar. Now we're getting into options. The first one we're going to talk about is a put. A put is where the buyer is betting the stock will go down below the strike price. Put buyers or buyers put down. Sellers or writers, when it comes to options, are on the other side. They're betting that the buyer is wrong. And it's one of the things that normally people think of, oh, if the buyer's betting it's going to go down, well, then the writer must mean it's going to go up. I mean, if it goes up, that means down was wrong. It wasn't wrong. It wasn't down. There's another one, though, and we've got to make sure we remember this with options especially, that being flat, not moving, is also not down. The seller, the writer, is believing it's going to stay up, go up, or stay the same, that it is not going to go down. Calls, on the other hand, the buyer is betting the stock will go up. Call buyers buy up. They call up above the strike price. Sellers are betting they're wrong, and they're wrong if it goes down or stays the same price. Buyers call up. Buyers also put down. We can also think of the animals. One of the things that we are going to have to understand at least a little are the animals that we deal with, bulls and bears. The way I always explain it, and I actually have a cartoon as well. I don't think it's in the presentation, though, at least not here. The idea is, how are these animals going to kill you? If a bull or a bear had rabies, hadn't eaten in a couple months, was really hungry and a bad attitude, and met you in the middle of nowhere, what would it do? It's a weird situation, but if it helps you remember what these words mean, all for it. Bulls are going to run at you and attack up, right? They're going to gore up. They're going to attack upwards. Bears, on the other hand, are going to get on their back legs and attack downwards. They're going to lunge downward on you. Bulls go up. Bears are betting down. Bullish means you thinking it's going to go up. You're optimistic. Bearish means you think it's going to go down. You're pessimistic. And if you think about buy, call, buy, B-U, call, L-L, the bull's right there. And you can make this chart if you ever forget. And you don't have to even worry about where things are. It doesn't matter if this is buy and sell or sell and buy, call and put or put and call, or if even the call and put's up here and the buy and sell are down here. It doesn't matter. As long as the buy and sell are in the same place and the put and call are in the same place, go find the buy a call. We know buy call is bull. So that's the bull. Diagonals are also going to be bullish. So whatever's diagonal from buy call, in this case the sell put, change both of them, you get the same thing. Double negatives, you could think of them. The other two are going to be the bears. They're going to be the ones that are betting up. Sorry, down. Bulls are betting up. Buying a call or selling a put are both bets it's going to go up. A put buyer, remember, is betting it's going to go down, right? Put down. So the seller is opposite, going up. Same thing with a buy call. Call buyers call up. Here's the basic definitions of these. We're going to be going through them, and I'm going to go through them again a little bit through these slides. This is where we're going to start hitting them. We're going to hit them again through these next few slides. The writer is the original seller. They're the one that has the obligation in the contract. It's important to understand the difference between the idea of me selling it versus me writing it. Because I just bought some option, put or call, from John, who sits in the corner of my room over there. I just bought it from John. Okay. John's the writer. John wrote the contract. I'm just the first person to buy it. John's the one with the obligation. If at some point while this option is around, is still alive, I decide I want to sell it. I don't want it anymore. And you buy it from me. I am not the writer of the option. I sold it. I sold it to you. You are the buyer. You are the owner. You own it. But John in the corner over there is still the writer. He's still the one with the obligation. As I was pointing out with the buyer and the owner, in this case now would be you if you bought it from me or me before then, that is the person who actually owns the security, the put or the call. They own it. And has the one with the option, the ability to exercise and force the writer into buying or selling. I can call securities from the writer. As a call owner, I can call it from the writer. That means I can call the securities. I can take the securities from the writer. Now I have to pay them, but I can do that. Or I could, if I had to put, I could put the securities to the writer. I could force the writer to take my securities. They have to pay me for them, and that's the strike price, the bet of which we're doing. The price that I have the ability to buy them from the writer at with the call, or the price that I have the right to force the writer to buy them from me, where I can sell them to the writer and make them pay me money. The strike price is what that money is. It's the bet. It's what the put buyer believes it will go down, what the call buyer believes it will go above. The expiration is the date that the options expire. They become worthless. As I like to joke, if these were actually printed on paper still, and you had one of these options, the day after the expiration date, the most useful purpose that that piece of paper has is as a fuel source. By that I mean burning it and using it for heat. That it has no other purpose other than as paper, which is flammable. The premium is the cost to actually buy the contract. Each contract, whether a put or a call, is for 100 shares. So to find the actual price to purchase the contract, you need to multiply the premium by 100. The break even is the price at which the buyer doesn't make or lose money. Neither does the seller. If I am able to buy it at 50, I can call it at 50, and I could go and sell it at 55. That would make me $5. But if it cost me $5 to make that $5, I broke even. I didn't make or lose any money. We're going to come back to break even a bit later. It is definitely tested and important, but I do want to keep going. We will come back to that later. Here's the basic chart as well. Market up. That's bulls. That's buying a call or selling a put or being long the stock. We're going to get to what that means shortly as well. Market down means you're bearish. Means you believe that the market's going to go down. So you could buy a put or sell a call. You're never going to be crossing these. I have not heard any of the options, complicated options contracts where you actually have to deal with what happens if you want to buy and sell a call or buy a put and a call. You're not going to deal with them. At least I have not heard that you're dealing with them over the number of people that I have spoken to so far. But you could also short the stock. We're going to get to what exactly I mean by shorting a stock in a few slides. But generally, if they're going to make you pick two of them, as some questions do, you want to pick the ones that are on the same level. Again, you're never going to be buying a call and buying a put or buying a call and selling a call. You might want to buy a call or sell a put. Those are both betting the market's going to go up. You might want to sell a call or buy a put. That's both betting the market's going to go down. Equity versus index. Equity options are what we normally think of, especially in test mode, on what options are. That I'm betting that IBM's going to go up or down. I'm betting that Microsoft's going to go up or down. I'm betting that such and such is going to go up or down. But a lot of options are on the index. The index is where the underlying asset is the value, where I'm betting the Dow is going to go up or down. I'm betting the S&P is going to go up or down. I'm betting things like that. Now, there are different ways of using options. You could use them for hedging or for speculating. Hedging is basically insurance, protecting. hedging oneself. Buying puts as insurance against a long buying position. I just bought 100 shares of IBM. What am I worried is going to happen? That I made a mistake because IBM goes down. So what if I also bought 100 calls? 100 puts. Well, if the market goes down, the puts pay off. If the market goes up, the stock pays off. So I'm protected if the market goes down. You could buy a call when you're short. We're going to get again into that. It's not, the questions on the hedging are much more on buying puts when you're long than dealing with calls when you're short. Speculation is gambling, betting. Buying calls to simply bet the stock is going to go up, not because you have some reason and you're using it like as a protection. Or buying puts to bet the stock's going to go down, not because you're actually long and using it as insurance. You just think the stock's going to go down, so I bet a put on it. I buy a put. I'm betting it's going to go down. As I mentioned, the expiration date is the date when the option expires and becomes worthless. Stock very, very, very rarely goes to zero. Now, Lehman went from, I think, $53 or something to, I think, 4 cents. That's pretty close to zero. People talk about it going to zero. I think the Big Short even said it went to zero. Technically went to 4 cents, which is a rather large loss, going from 50-some dollars to 4 cents. That's a significant loss. I will give you that. Nobody can deny that. But it's not zero. You still have something. Options go to zero. They go to worthless. The strike price is the bet price of the option. The price a call buyer thinks it will go above, and the price a put buyer thinks it will go below. The premium, as I mentioned, is the cost to purchase the option, or the amount the writer will receive initially. When an option is first purchased, the writer is the one that gets the money. After that, if I sell it, I'm the one that gets the money. Each option is for 100 shares. So we want to multiply the premium by 100 to find the true cost in dollars of the entire contract. Now it gets a little bit weird. When it first comes out, the price is whatever the writer basically wants. There's some rules in it basically, but once it's out there, the market price, what determines the value of this option contract, is twofold. There's basically two components of the option. After the initial sale, there's an intrinsic value. If I am betting the stock is going to go above 50, this is a call at 50, and the stock is currently at 60. That means I could call it from the writer, paying them 50. That's what we agreed to. I could then immediately sell it on the open market at 60, making $10 a share. That is the intrinsic value. How much in the money? How much is it worth if you used it today? How much is that worth? That's the intrinsic value. Now, if I was betting it was going to go above 50 and the stock's at 45, there is no intrinsic value. Then it's called out of the money. We're going to get to in and the out of the money again in a few slides here. But that's not the only thing. My option for 50, that's currently trading at 60, I don't want $10 for it. I mean, I've still got 6 months. I think the stock's going to go up higher. I want you to give me $16 for it. I know it's worth 10, but you have 6 months of potential growth. I don't know, maybe it'll go down, but I think it's going to go up. So you also have what's called the time value. How much time remaining is going to affect the purchase price? If my option at 50, when the market's at 60, expires tomorrow, yeah, it's really not going to be worth more than $10. But if it expires in 6 months, yeah, it might be worth 2 or 3 times it, depending on what the industry thinks, what the market thinks. Do they believe this stock is going to keep going up? Do they think it's going to keep going down? Maybe it's not worth as much. Time value isn't always high. You'll see some animations below. When this first came out, they aren't there, but they will hopefully be coming shortly. There are several animations, including one on valuing options and the time value, intrinsic value, things like that, where I go through and try and show, using an actual options chain, how options are priced to hopefully make that make a little more sense. Underlying or cash settlement. The way that I've been describing it, the way I like describing it, because I think it helps students, is only really is underlying, where I buy the stock with the call, or I sell the stock with the put. Well, if my option, my call is 50, it's currently at 60. So I pay John Jim, whatever I was calling my imaginary broker over there, I pay them $50 a share. Okay, now I have the stock. I'm out $5,000, $50 a share, 100 shares. I'm out $5,000. I then go and I sell it on the open market at $60 a share. 60 a share, 100 shares, that's $6,000. I just made $1,000. But I had to go and buy from John and sell over there to the another broker dealer. Why couldn't John just give me $1,000? I mean, he's out $1,000 because he's got to go and buy it at 60 to be able to sell it to me at 50. So he's out $1,000. Why doesn't he just give me the $1,000 instead of having to do those trades? And that's the idea of a cash settlement, where the seller or writer simply pays the in the money value, how much it would actually be worth, how much I would get if I actually executed and did an underlying settlement. They simply pay that to me. And this is actually how most options settle. All index options also settle this way, as you can't actually trade shares of the index. They don't work that way. So when you buy index options, they're always going to be cash settlement. In the money and out of the money. When the price of the underlying asset of the call is above the strike price, when the call is a good bet, I'm betting it's going to go above, and it is. Or when the put is a good bet, I'm betting it's going to go below, and it is. That's in the money. The difference between the strike price and the market price is how much in or out of the money, depending on which direction it is. If the strike price is 50 and the stock's either at 40 or 60, well, it's in or out of the money by 10, depending on which way it is. If it's a call, if it's above, it's going to be in the money, and below, it's out of the money. If it's a put, below, it's in the money, and above, it's out of the money. Covered and uncovered. Covered calls are when someone writes a call, but also owns the underlying security. Worst case, I just lose the security. I bought 100 shares of XYZ a couple years ago, many years ago, at $10. Currently, it's trading at $50. And I don't really think it's going to go up, but I really like XYZ. It's been doing great for me. So I don't want to sell it, but I want to try and make some money. So I write a call. Writing a call, if you think about it, buying a call up. Writing a call means I'm betting it's going to go down, because I think it's going to go down or stay the same. I just don't think it's going to go up. So I sell the call. You buy the call. So you have the ability, the strike price is say 55, let's say a little more, that you could make me sell you these shares at 55. If the market goes down, you're not going to do that because you could buy them at a lower price. So I get to keep the premium you paid me. If the market stays flat, you still could get it at a lower price. I get to keep the premium you paid me. What if the market goes up? What if I'm wrong? Selling a call means I'm betting it's going to go down. What if it goes up? I've got to sell my shares at 55. Yeah, now they're worth 80 or 90, and I missed that. Oops. But remember, I bought them at 10. So I'm selling them at 55. I just made $45 a share. I just made a lot of money on that. Yeah, I could have made more if I didn't believe it would have gone down, but I still made some money off of that. I still made the premium off of that. Uncovered or naked calls, or when someone doesn't own the underlying security. And these get scary. I don't understand why anyone does these. What is the worst case? You're writing a call, you're betting it's going to go down. What if it goes up? Well, how high could it go? What is the highest price a stock could go? If you want to see what a reasonably high price stock is, go and type in BRK-A into Google. That is Berkshire Hathaway A shares, and it is the most expensive stock, single share. Last I checked, it was $330,000 per share. Stock could go to that high. It's not going to, but it could. In which case, I have to go and buy the stock at that price to be able to sell it to you at a much lower strike price. Which means I have potentially unlimited loss. I have the potential to gain a couple $100 or lose literally everything. Very, very dangerous. I don't understand why anyone would do naked calls. The risk just doesn't make any sense to me. American and European. American options can be exercised any time before the expiration. If they don't specifically ask you or tell you what the option is, assume it is an American option. European options can only be exercised on their expiration date, not before. That's the only difference. And it's unlikely that you're really going to see this, but still want to cover it just in case. Exercise and assignment. Exercise is the right of the owner of the option, put or call, to exercise the option and force the writer into their obligation, into assignment. Assignment is simply that obligation. The obligation that the writer is agreeing to when they sell that option initially and they get paid the premium to fulfill their contract, to fulfill the contract and control there. Either they purchase shares at the given strike price in a put. I can put my shares to the writer. That means they must pay me. Or I can call the shares from the writer, meaning I have to be able to buy it. They have to sell them to me. Strategies. We mentioned long. Long is the simplest. Long is what most people think of. Long is what almost certainly 100% of your clients are going to be. Long is purchasing, wanting to buy low and sell high later. Buy low and sell high. Buying low and selling high is great. We want to buy low and sell high. We don't want to sell high and buy low. That's bad. Buying high and selling low, you lose money. We want to buy low and sell high. What if we switch it? Again, not buying high and selling low. But instead of buying low and then later selling high, what if we sold it high to later buy it low? That is what short selling is. Borrowing. Wanting to sell it high now in order to buy it back later when it's low. I'm borrowing the security. I'm selling it for cash, and then I'm hoping when the price goes down later, I can buy it for less to give back the security that I borrowed. So here's a story. I believe the investment is going to go down. So I borrow 100 shares of ABC from Jeff, my partner. Each is worth $100. So I sell those 100 shares. I now have $10,000 in cash. In a few months, I was right. ABC goes down. It's now at $80 a share. Remember, I don't owe Jeff $10,000. I owe him 100 shares of ABC stock. So I take the $10,000 I have in my pocket and I go and buy 100 shares of ABC, $80 a piece. That's $8,000. So I have 100 shares of ABC and $2,000 in my pocket. I give Jeff back his 100 shares, and I keep the difference. Well, I give him some interest. I'm borrowing. I've got to pay him some interest. And I get to keep the difference. Thus, I sold it high, $100 a share, and then later I bought it low at 80. But, just like when you're selling calls, what is the highest ABC could go to? I have to buy 100 shares. I have to give him 100 shares back. If ABC is $200 a share, or 3 or 5 or 10, I'm going to be out a lot of money. That's why with selling short, you're betting it's going to go down. So if you also buy a call, that's hedging a short position in the exact same way that buying a put is hedging a long position. Here are the basic profit loss tables for the options. All of these have a strike price of 50. All of these have a premium of $5. If we look at the buying a call, the long call, I am betting it's going to go up. As it goes up, I start making more and more money. But initially at 50, I paid $5. So I'm out the $5 a share, which is the same as if it goes down. If I'm wrong, the most I'm out is that $5. Has limited liability. That's the most I can lose is my initial investment. But even as it grows, I'm still negative. It's got to grow at least that premium, at least that $5 that I paid for me to break even. Above that, I start making money. We can look at this selling a put. That's also betting it's going to go up. But when I'm selling a put, the most I can make is that premium. I could lose as it goes down, but the most I could lose is when this hits zero. The lowest the stock can go is zero. It can't go negative, but it could go to zero, in which case I lose the difference there. These are the bullish ones. You're betting it's going to go up. These are the bearish. I'm betting it's going to go down. Buying a put, as it goes down, I make more and more money. If it goes up, I don't lose any more than my initial investment. Buying options, you have limited liability. Selling options, you don't. As it goes down, I don't lose any more. But if you notice, I start out negative. I'm out $5 at here. As it goes up, once it crosses again that break-even point, I start making money. Same idea with selling a call, though. I'm betting it's going to go down. But if it goes down, I just make the premium. Because the call buyer isn't going to use it. It's just going to expire. But as it goes up, I start losing more and more and more money with no limit. These are the bearish options. Notice as well, when you're dealing with these, that all of these, the buying a put or selling a put, both break-evens are at 45. Buying a call, 55. Selling a call is 55. The break-evens are the same across the options, whether buying or selling. Calls have the same break-even. Puts have the same break-even. So here is the table sort of summarizing a bunch of the information that does get tested. What is the maximum gain or maximum loss on these options? Well, the maximum gain on a long call, I'm betting it's going to go up. What's the highest it could go? Unlimited. What's the max loss? Long positions have limited liability. The most I could lose is what I paid. What if I'm a short call? Well, a short call, the most you can gain with a short position is the premium. If it expires because the buyer doesn't use it. What's the most I could lose? There's no limit to how much I can lose. It's unlimited. Notice as well, these are crossed. What's unlimited here is unlimited here. Premium paid, premium paid. The most that one side can lose is what the other side can gain. When you're long a put, what's the maximum gain? Well, if the market price goes to 0, that means you could buy it at 0 and sell it to the writer at the strike price, which means you'd make the strike price, but you still paid the premium. So in the best case scenario, if the price goes to 0, you get the strike price less the premium as pure profit. But the most you can lose is the premium you paid. You're long an option. The most you can lose in a long position is that initial premium. When you're short put, again, same with the short call. The most you can gain is the premium if the option expires worthless. The most you can lose is the most the other one can gain. These always cross. If this goes to 0, I'm going to have to pay the strike price to the buyer. And I'm not going to be able to make anything from it. I'm just going to have to pay him the strike price. And I'm going to have to sell it for 0. The break even for a call, remember, is a call is betting it's going to go up. So it's got to go up at least the premium. A put is betting it's going to go down. So it's got to go down at least the premium. Is it better to invest during a bull market or a bear market? Depends. Would you rather be gored or mauled? This summarizes that wonderful idea on rabid bulls and bears finding you and unfortunately doing bad things. But remember, bulls attack up, bears attack down. The options clearing corporation deals with listed options. We're going to talk about this a little bit more in a later chapter when we talk about things called SROs, self-regulatory organizations. The OCC is an SRO in charge of options. They manage listed options. They provide clearing and settlement services for 15 exchanges in equity options and futures. They publish the ODD, the Options Disclosure Document. That is a publication of the OCC that must be read by all first-time options traders. Options have significant risks. They need significant disclosures. All new traders must sign this. That brings us to the end of derivatives. I hope not too many people had seizures or heart attacks or strokes during this. If so, make sure you get appropriate medical help and then come back and rewatch it. You do need to know this chapter. If you have any questions, let me know. I'll be seeing you again shortly when we're starting to talk about pooled investments.